A loss-making startup wants a supermarket's valuation. Zepto is preparing an IPO to raise 8,100 crores in fresh capital, with a reported valuation between $7 billion and $8 billion. Some bankers are even whispering $10 billion. That number sounds insane, because Zepto still loses money on orders it delivers in minutes. The app did not exist 5 years ago. Now it claims 22,624 crores in revenue, handles 640 million orders a year, and has built an advertising engine worth 1,636 crores. CalPERS, one of the world's largest pension funds, backed it at a $7 billion valuation. But here's the ugly part. Even in its best quarter, Zepto lost 59 rupees on every order. So the real question is brutal. Is this the next Amazon-style machine, or a beautifully wrapped cash furnace? That is the IPO.
To understand Zepto, forget the speed. 10-minute delivery is not the story. The real story is hidden inside one number.
Blinkit's average order value is about 525 rupees. Instamart stands near 504 rupees. Zepto sits much lower, around 388 rupees per order. That gap changes everything. DMart sells many of the same everyday products. In FY26, it earned 2,970 crores of profit on 68,821 crores of revenue. The market values it at 3.79 times sales. Zepto, meanwhile, lost about 5,900 crores and may ask for 7 to 9 times sales, depending on IPO pricing. That is the tension. A profitable retailer gets 1 multiple. A 4-year-old loss maker wants nearly the same. So how did this become convincing? The first twist is that Zepto is not really a delivery app. It is not a simple marketplace either. It is a retailer wearing the costume of a tech company. A marketplace connects buyers and sellers, then collects a commission. Zepto buys or controls the grocery flow, stores inventory in dark stores, and sells products through its own system. That means its reported revenue includes the full price of goods moving through its books. In the prospectus numbers, total order value divided by total orders gives roughly 388 rupees per order. From that order, Zepto earns in 3 ways: product margin, customer fees, and brand advertising. After paying for the goods, Zepto keeps about 56% of the order value on a 388 rupee basket. That is merely 72 rupees. Now comes the knife. Zepto does not spend 72 rupees to serve that order. It spends far more. There are fixed costs and variable costs. Fixed costs are paid whether customers order or not. Rent, store salaries, cold storage, central teams, and overheads all sit there waiting. But fixed costs have one magical property. When orders rise, cost per order falls. Take a dark store with rent of 3 lakhs. If it serves 1 lakh orders, rent is 3 rupees per order. If orders double, rent falls to 1.5 rupees per order. Zepto's dark stores used to process about 1,279 orders a day. Now they process around 2,140 orders a day. The same shelves are working much harder. Fixed cost per order dropped from 72 rupees to 34 rupees. Scale is doing real work, but fixed costs are only half the wound. Variable costs show up every time someone places an order. The rider must be paid. The packer must pick the items. Packaging must be used. Mid-mile movement must happen before the bag reaches the dark store. Zepto's supply chain variable cost is about 64 rupees per order. Pure delivery and handling are roughly 48 rupees. Unlike rent, this does not vanish with more orders. 1 million orders still need 1 million deliveries. Then there is marketing. A year earlier, Zepto spent almost 34 rupees per order just on digital marketing. Now that figure has crashed to 4.31 rupees. That sounds excellent, and it is. But it also means one thing. Most of the easy savings are already gone. Add everything together, and FY26 cost per order was 171 rupees. almost 151 rupees. Zepto kept 72 rupees and spent 151. That creates a loss of roughly 79 rupees per order across FY26. Now multiply that by 640 million orders. This is why the IPO debate is so explosive. Zepto is not losing money quietly. It is losing money at enormous scale. But investors are still listening because the loss is shrinking fast. In the January to March quarter, loss per order fell to 44 rupees. 1 year earlier, that number was around 143 rupees per order. In 12 months, the whole was cut by more than half. This is the 59 rupee problem. If Zepto can turn minus 59 into plus 1, the story changes overnight. A cash-burning machine becomes a profit engine. That is the entire bet. The first lever is advertising. In 2015, Wall Street mocked Amazon for thin retail margins. Then, Amazon revealed AWS, the hidden cloud business inside the company. Later, its advertising business became another profit monster. Retail platforms everywhere studied that playbook. Use low-margin shopping to build daily user traffic. Then sell attention to brands fighting for shelf space. Zepto's ad growth is shocking. In FY24, advertising revenue was 49 crores. In FY25, it jumped to 651 crores. In FY26, it reached 1,636 crores. Quarter by quarter, it went from 1 crore to 543 crores in about 3 years. That is not normal growth. Ad money is powerful because it has no rider, no package, no warehouse trip, and no spoiled inventory. Industry estimates place margins above 90%. So inside Zepto's 72 rupees of take per order, ads matter more every year. Ad contribution rose from 4 rupees in fiscal year 2024 to 20 rupees in fiscal year 2025 to 26 rupees in fiscal year 2026. Groceries are thin. Ads are fat. The dream is simple. Push Zepto's take from 72 rupees toward 85 or 90 rupees, while cutting cost from 151 rupees toward 100. When the lines meet, Zepto breaks even. But here is the ceiling. If ads alone had to close the 59 rupee gap, ad revenue would need to reach about 85 rupees per order. On a 388 rupee basket, that means 22% of the entire order would be advertising money. No major retail platform is close to that. Brands cannot bleed forever. A product selling for 200 rupees may lose 30% to manufacturing cost. Trade margins can take another 20% to 40%, so use 30%. Already 60% of revenue is gone. The brand is left with 40%. Then tech, payments, and logistics take another 5% to 8%. Now the brand has roughly 32%, or 64 rupees, before advertising. Then quick commerce demands visibility. The product disappears inside the app. Ad spend often eats 20% to 35% of revenue. That is how 64 rupees can collapse into just 5 to 10 rupees of contribution profit. And that is before the brand pays its own fixed costs. This is the squeeze. Zepto's 2 richest income levers are trade margin and advertising. Both come from the same brand economics. Push too hard, and suppliers start losing money. But customers may not accept endless delivery and handling charges. So the next question becomes unavoidable. Can Zepto cut costs instead? Open the 151 rupee cost stack, and the answer gets uncomfortable. Rider and packer costs sit near 61 rupees per order. Over 3 years, that number moved from about 63 rupees to 61 rupees. There is not much room left without harming the people doing the work. Digital marketing fell from 34 rupees to 4.31 rupees per order. Payment gateways, technology, and server costs exist, but if profitability depends on shaving those, the business is fragile. The obvious levers are nearly exhausted. Only one large cost lever remains: fixed cost efficiency. Fixed cost per order is around 52 rupees after peaking at 87.71 rupees during expansion. It fell quickly because existing stores began handling far more orders. But Even this has a limit. A standard Zepto dark store now averages about 2,140 orders per day. Industry conversations suggest a practical ceiling near 2,500 orders per day. That means fixed cost can fall further, but not forever. On cost-cutting alone, Zepto might reduce the 59 rupee gap to perhaps 25 or 30 rupees. After that, progress becomes much harder. It is basket size. This is where many people misread quick commerce. They assume the platform must keep selling the same grocery basket forever. But average order value can rise in two ways. Customers buy more items, or the platform adds higher ticket categories. Use a consistent formula across platforms. Take net order value from the January to March quarter, then divide by orders. Zepto comes out near 361 rupees per order. Instamart stands around 504 rupees. Blinkit is close to 524 rupees. Flipkart Minutes is reportedly around 750 to 800 rupees, though company-level disclosure is not available. Zepto has the smallest basket. Now picture one scooter leaving a dark store. The rider cost, packer cost, packaging and mid-mile movement total about 61 rupees. Add fixed costs near 50 rupees. The total burden is roughly 115 rupees per bag. Here is the magic. That 115 rupees is almost the same whether the bag is worth 361 rupees or 550 rupees. Same rider, same scooter, same shelf. On a 361 rupee order, 115 rupees consumes about 32% of the basket. On a 550 rupee order, it consumes only 21%. The cost did not fall. The order became bigger. If Zepto can push average order value above 550 rupees while keeping its store throughput high, it gets close to break-even. But there is a warning hidden in Instamart. Its bag is around 504 rupees, yet it lost about 85 rupees per order in FY26. That is worse than Zepto's 79 rupee loss. Why? Throughput. A Zepto dark store processes roughly 2,140 orders per day. Instamart stores are closer to 1,100 orders per day. Fixed costs spread across fewer orders stay heavy. High average order value plus high order volume creates the path to profit. Blinkit appears to have both. Instamart has stronger basket size but weaker throughput. Zepto has strong throughput but weaker basket size. So Zepto's mission is clear. Keep the stores busy, raise basket value, grow ads carefully, and avoid crushing brands. That is a narrow bridge. The genius of Zepto is real. It built massive order density, reduced marketing dependence, grew ads from 49 crores to 1,636 crores, and cut per order losses from 143 rupees to 44 rupees in a year. The danger is also real. It still loses money per order. Supplier economics have limits. Ad revenue cannot rise infinitely, and dark stores cannot process unlimited demand. This IPO is not a simple growth story. It is a math test dressed as a speed story. If average order value rises toward 550 rupees and throughput stays near 2,140 orders per store per day, the business may approach profitability. If basket stays small, the cash burn continues. Read the filings. Study the unit economics. Speak to a licensed financial professional before making any investment decision, because Zepto's secret is not speed. It is whether 59 rupees can disappear. If it disappears, Zepto becomes a machine. If it does not, the fastest delivery in India may just be delivering losses faster than anyone else.